As anticipated, the Bank of England kept interest rates at 5.25% today, keeping rates unchanged for the fifth consecutive meeting. While guidance did not materially change, there was a dovish tilt to the meeting as the committee reflected more confidence that rates are bearing down on inflation indicators, and also there was a softening of their language around the labour market. The bank is, however, still building up an evidence base to cut policy rates. And while the data is still moving in the right direction, it's still mixed, and that wage growth measures are not yet consistent with inflation falling sustainably in line with their inflation target of 2%. In particular, they note that the decision-maker panel wage growth expectations remained flat at 5.2%. So two important points that we wanted to draw upon was, firstly, there was a more dovish split than was expected, as Catherine Mann and Jonathan Haskell dropped their previous votes for hikes and joined the modal group for unchanged rates, while Swati Dhingra continued to judge that a rate cut was still appropriate at this meeting. It's important to note that this is the first time since September 2021 that there have been no votes for a hike. Secondly, the meetings noted that the MPC recognised that even if Monetary Policy Committee did cut rates, they would still remain restrictive. And this is sort of a notable firming and may imply a lower burden of proof to the initial cut. So encouraged by the 8-1 vote split and the lack of a hawkish dissent, interest rates rallied and sterling weakened after the announcement, as markets priced in an increased probability of an interest rate cut in June this year. And unlike the Bank of England, though, we remain focused on the evolution of data, and in particular wage growth data, especially in light of the national living wage increase of 10% in April and the potential impacts of the pay data. So our base case remains that cuts are still some months away, as the bank broadly remains cautious and data dependent.